Everybody, welcome to today's Fundamentals. Hello, Peter.
Hello.
A new day, a new week. What's up in the market?
Well, we had a quiet start and the US dollar edged a little bit higher. But overall, I think that the market slowly but steadily restarting its engines and we're going to be having a busy week ahead.
Mm-hmm. And how about the US stock markets?
Well, US stock markets were kind of tricky. They were on the rise on Friday, yet during today's Asian European session, American stock markets seem to have started to drop, at least forward ones. And we're highlighting that we're having a number of earnings releases which could generate substantial interest among traders. Characteristically, I would be highlighting on Wednesday Alibaba and GlaxoSmithKline. On Thursday, we're getting Merck and the main releases on Thursday are expected to be high tech.
Mm-hmm.
We're getting Apple, we're getting Google, we're getting Facebook. So I would expect that as the week progresses, more and more interest may start shifting towards US stock markets, especially on Thursday.
Mm-hmm. Mm-hmm.
Other than that, I think that we may see some decent movements in the FX market as well, as we have a number of high-impact financial releases and monetary policy events.
And what's on the calendar for today?
Actually, we had already in the European session Sweden's and Germany's GDP rates. There's nothing substantial expected in the American session, but in the Asian session tomorrow, we're getting from Japan the industrial output growth rate and the retail sales growth rate, both for December. I would be highlighting the final retail sales growth rate of Australia. And I would also be highlighting from China the NBS manufacturing PMI figure. It's for January. I think it's the first month where the Chinese economy has started to reopen. It's not a full month, but still. And it's going to be an interesting read in the sense to see whether the giant Chinese manufacturing sector has started to regain some traction and has increased economic activity or not.
Mm-hmm. And how about the rest of the week?
Well, as we've mentioned, it's a busy week ahead. We have on Tuesday from Eurozone the preliminary GDP rate. It's for Q4. I would also be highlighting from Germany the preliminary HICP rate for January. And from Canada, we get the GDP rate for November. On Wednesday, we have China's Caixin manufacturing PMI figure, which complements the NBS manufacturing PMI figure, which is due out tomorrow. I would be also noting from the Eurozone the preliminary HICP rate for January. And I would also be highlighting from the US the ISM manufacturing PMI figure. It's also for January. There's a catch here, and the catch is that it may get overshadowed, probably will, from the Fed's interest rate decision.
Mm-hmm.
It's set for 9 o'clock in the evening Cyprus time, and the market more or less expects that the bank will downshift its rate hiking path and deliver a 25 basis points rate hike.
Mm-hmm.
Should that be the case, which most probably will be, then the attention will be turning towards the accompanying statement and what the tone will be. Should the bank adopt a hawkish tone, confident tone, we may see the US dollar getting some support.
Mm-hmm.
Other than that, I would be also noting on Thursday we have 3 interest rate decisions. We make a start with Bank of England in the UK. The bank is expected to deliver 50 basis points rate hike. And most probably the cost of living crisis in the UK economy is going to maintain a hawkish tone in BOE's accompanying statement. Also, we're getting from the ECB its interest rate decision, another 50 basis points rate hike is expected. And I would expect more or less the ECB to more or less keep a steady path in its forward guidance about future rate hikes, given that inflation has slowed down, but it's still at quite high levels and a far cry from the bank's 2% target. Other than that, I would be noting from the Czech Republic CMB's interest rate decision and from the US, We get the durable goods orders growth rate and the initial jobless claims figure. The initial jobless claims figure, the importance is that it's practically the last data of the employment market of the US before the release on Friday of the US employment report for January. Now, the expectations are for the non-farm payrolls figure to drop, unemployment rate to tick up, and average earnings to remain unchanged on a month-on-month basis. Now, such a reading could weaken the US dollar, as we have practically the two main elements of the release, the NFP figure and the unemployment rate, aligning towards a slack in the US employment market. On the flip side, unemployment remains, despite a possible tick up, at very low levels. So that would imply that the US employment market remains tight, and definitely it's no obstacle for the Fed's hawkish intentions. So overall, I would expect that we may see the USD gaining somewhat, yet I would like also to see what the actual rates and figures before I make up my mind about the direction of the US dollar. Other than that, on Friday we're getting also from the US the ISM manufacturing PMI figure. It's for January, and it complements the ISM manufacturing PMI, which is on Wednesday.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
Welcome to the technical analysis part of the presentation. My name is Peter Iosif, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour time frame. And mind you that all charts to be presented are to be of the same time frame unless otherwise stated. I would be highlighting here that we have a clear sideways motion, and that would be just above the 101.30 support line. Overall, we tend to maintain a bias for the sideways motion to continue. Note how narrow the Bollinger Bands have been, which more or less highlight the low volatility for the index. The RSI indicator is near the reading of 50, yet seems to be dropping, which may be a prelude for some bearish movement here. Should the bears actually take over and lead the index, we may see the US dollar index dropping, breaking the 101.30 support line, and start aiming for the 99.55 support level. On the flip side, should the bulls take over, we may see the price action rising, testing, if not breaking, the 103.05 resistance level, a level which provided resistance back here. Okay, let's have a look at Euro USD. Also in a sideways motion. Let's readjust the charts a little bit. And definitely the labels. So we have Euro USD, which remains in a sideways motion, and that's just below the 1.0935 resistance line. Once again, note how the Bollinger Bands have narrowed, which tends to imply low volatility, which may allow the sideways motion to continue. And there is an interesting element here that the RSI indicator was near the reading of 50, yet seems to be on the rise in the Asian and early European session today. Now, should that rise continue, we may see Euro USD getting a boost, and in which case we may see it breaking the 1.0935 resistance line, start aiming for the 1.1055. Mind you that the 1.1055 is pretty close to the R1. So I wouldn't be surprised to see the price action, should the bulls actually take charge, breaking above the R2 as well. However, let's have a look where the R2 rests. Yep. Okay. Let's readjust. So overall, we tend to maintain a bias for sideways motion to continue below the 1.0935 resistance line. On the other hand, should the bears take over, which may not be so probable, but still is a possible scenario and should be covered, we may see the price action dropping, testing if not even breaking the S1 1.0730 support line. Okay, let's have a look at GBP USD. We're adjusting the chart once again. There it is. Another sideways motion just below the 1.2345, which provided resistance once, twice, 3 times. So that's pretty valid. We tend to maintain a bias for a sideways motion to continue. Note how the RSI indicator continues to run just above the reading of 50. It's actually right now at 54.7. And in our opinion, that tends to highlight the prospect for another sideways motion, or at least for the sideways motion to continue. Yet should the RSI indicator start to rise, which does not seem to be the case now, but it's still a possibility, then we may see GBP USD getting some support, breaking above the 1.2345 and start aiming for the 1.2660. On the other hand, should the bears take over, we may see the price action of GBP USD dropping, breaking the 1.2220 and start aiming for the 1.19. A little bit far wide, but definitely a break below the S1 will be required for a bearish outlook. For the time being, we tend to maintain a bias for the sideways motion to continue. Let's have a look at USD JPY. We're adjusting a little bit the chart. Now we have a change here which should be noted. The price action has broken and clearly remains above the R1 1.2930. Note also these touches here. 1, 2, 3. All three of them verified the switch of the 129.30 from a resistance line to support line. So let's correct that. Color that is in green. And let's go hunting for a new ultimate resistance line. I would be placing a resistance line somewhere here. And the main reason is 1 touch, 2 touches, but also note how this level also acted as a support line. Seems to be pretty valid. In red, and that would be the 137.75. Correct the labels as well. Opening up a little bit. The S3 now is being placed at 124.75. The S2 at 127. The S1 at 129.30, given that the price action has broken clearly above it. And the R1 at 131.80. The R2 at 133.90. And the final resistance line is being placed at 137.75. A little bit far off. Definitely disproportionate with the distance between the R1 and the R2. However, given that we have a nice resistance level here, I wouldn't miss it. Could there be a mid-level? Maybe somewhere here. But for the time being, I'm covering this ground up until 137.75. For the time being, we tend to maintain a bias for the sideways motion to continue, most probably above the 129.30 support line. Note also how the RSI indicator is running along the reading of 50, also implying that possibility for the sideways motion intensifies, while the narrowing of the Bollinger Bands once again tends to imply that more or less volatility is on the downside and once again could allow the sideways motion to continue. All currencies we have seen up until now seem to be, to one extent or the other, driven by the US dollar. Yet, with the exception of USD JPY and GBP USD, I would be highlighting also that the euro may find some interesting releases which allow it to draw a more independent course against the US dollar. We have a number of high impact financial releases this week, and definitely ECB's interest rate decision will be closely watched by euro traders, as will also BOE's interest rate decision be closely watched by pound traders. The yen, on the other hand, though, may have little to worry about. Despite some high-impact financial releases coming out, I think USD JPY may remain more dollar-driven than the others. Should the bulls take over, we may see the rise of USD JPY to the 131.80, which used to be a support line, has been broken given that the price action is now below it and has been turned into a resistance line. Even higher, we note the 133.90. To the downside, and should the best take over, I would expect the price action to break the 129.30. Definitely, we would require lower throw than this one and this one and this one as well. So I would expect the 129.30 to be broken, the S1, and the price action to start aiming for the 127. For the time being, sideways motion expected just above the 121.30 support line. Let's have a look at USD CHF. Interesting chart. Okay, let's readjust a little bit the labels to to make them a little bit more visible. Now the 0.9210 seems to be holding its ground. Definitely it's providing some difficulty to the pair to continue. I would be noting though that the pair seems to be dropping somewhat in the late Asian, early European session. It's indicative also how the RSI indicator has dropped, but nothing conclusive yet. I would be noting or expecting the sideways motion to continue for the time being. And I would also be noting that for a bearish scenario, I would require lower show than this one. So I would expect the price action to reach as low as the S1, even breach it, the 0.9090. I think that would be a clear indication, given that it's a level which was tested also here. On the other hand, should we have a bullish scenario, then we may see the price action rising, breaking the 0.9210. Yet at this point, I would require also a breaking of the 0.9330, a level which provides resistance here, here, and here. For the time being, base scenario remains that the sideways motion is to continue. Mind you, once again, possibly maybe USD driven pair. Let's have a look at AUD USD, commodity currency pair. Nice bounce. Let's correct this. Okay, we have a switch here, which we should notice. See how the price action has risen. It was very indicative. Yet has broken the upward trend line after hitting a ceiling at the 0.7130. And that practically forces us to switch these two resistance lines into support lines. And we're going to go hunting once again for new ultimate resistance lines. Locking them in. That's one. And that would be in red. The 0.7265. Nice peak here. Let's go hunting. Okay, this is a little bit of chart, but still has a nice touch here and a nice touch here. Also to the downside. I'm keeping this. There could be a mid-level here, here, but I'm going all the way. In red. And that would be the 0.7465. Readjusting the charts. Let's correct also the labels. Here you go. Now the S3 now is being set at 0.6740. The S2 at 0.6880. The S1 at 0.7130. sorry, 0.7010, and the R1 at 0.7130. The R2 is now being placed at 0.7265, and the R3 at 0.7465. Where's that 55? Give me a sec. Let's have a look. Sorry, that would be 0.7455. Locking everything in. Now let's discuss direction here. This is the 4-hour chart. We can see that the price action was on the rise, and that was since the 19th of January up until the 27th, practically on Friday, where it remained on a sideways motion, breaking the upward trend line. And that would be implying that more or less we have a continuation of the sideways motion since Friday. Yet note the bearish candlesticks in today's late Asian and early European session, which more or less tended to imply that it may start going downhill. I would like to have another look at the daily chart though. Let's drill out. It's an interesting element in the following sense that let's have a look at this. So in a more long-term view, the bulls are still in the game. That possibility should not be neglected. Beautiful higher peaks and higher troughs. So in a more long-term sense, we see that there is still a bullish outlook here present. Also note how the RSI indicator is pretty high. Despite correcting lower, it's still at 66. And let's drill back into the 4-hour chart. In the short-term view though, say in the next 24 hours, as we have noted, there was a breaking of the upward trend line, and there was some slight bearish tendencies here. For the time being, we tend to maintain a bias for sideways motion to continue, given that the RSI indicator in the 4-hour chart is actually near the reading of 50. It's at 52, 53.7, sorry. So I wouldn't be surprised to see the sideways motion to continue between the 0.7130, just below it. And for a bearish outlook, I would require clear breaking of the 0.7010 support line and the price action to start aiming for 0.6880. That would also provide a breaking of the upward trend line we have noted since the 19th of January. A clear bearish sign. On the flip side, should the bulls regain control, we may see the price action rising, breaking the 0.7130 and start aiming for the 0.7265. Okay. Let's have a look at USD CAD, the other commodity currency pair. Way down. Okay, definitely the S1 has been broken clearly. It has even served as a resistance line at some point. So let's turn this into resistance level. Let's go hunting for a new support line. Unlocking the chart. Going back. This is a beautiful throw. I'm going all the way plus the shadow here, despite here being some touches. No, I'm going this way. And that would be in green, the 1.29 and a half, 1.2950, sorry. Locking in, readjusting. Let's correct the levels as well. Moving lower. Here it is. 1.37, 1.3525, 1.3395. That's the first resistance line, locking everything in. 1.3230, 1.3095, and the final support line being placed at 1.2950. It's an interesting chart because, in contrast to other pairs we have seen up until now, there seems to be a downward motion, and it would be interesting to see it. It is. You see that the pair is forming lower peaks and lower troughs, which tends to imply a bearish outlook here, and we tend to abide to it. We're keeping the bearish outlook, and in which case I wouldn't be surprised to see the price action dropping, breaking the 1.3230, and start aiming for the 1.3095. The RSI indicator, on the other hand, is still not as low as I would wish for. It's at 41.6, which may imply that some tendencies for stabilization may also be possible. But in case we see the pair stabilizing, I would expect, as a first sign of a change in the bearish trend, for the price action to break the downward trend line, yet respect the 1.3395 and the 1.3250. I think that would be an indication that more or less the price action has stabilized, yet remains in sideways motion. For a bullish outlook, we would require once again a breaking of the downward trend line, once again serving as a first signal of a change of trend. And I would also require, though, a breaking of the 1.3395 resistance line, a level which, if broken, may open the potential for the bulls. Now, before discussing anything else, let's have a look also at the daily chart. I'm a little bit interested and intrigued here. Yeah. I think the bearish outlook is in order here. See how the Bollinger Bands have shifted to the downside as a slope. Also the 50 moving average. Okay, the 100 moving average is still holding in sideways motion, but I think we see here a downward motion being formed. On the other hand, once again, back to the 4-hour chart, we cannot exclude or help but noticing that there are also some tendencies for stabilization for the pair. Okay, let's have a look at WTI prices, given that we have just looked at the Canadian dollar, which is positively linked to oil prices. Sideways motion. A very, very wide sideways motion. Let me readjust the chart. Let's readjust the labels as well. Okay, here we are. Let's discuss direction. WTI prices seem to be maintaining a rather wide sideways motion between the 83.20 resistance line and the 78 support line. There is a catch here. The catch is the RSI indicator, which is actually a little bit low. It's at 42.6, which tends to imply that we may be seeing some bearish tendencies here. It's interesting once again how the price action is practically flirting with the lower Bollinger Band. Has broken the 100 moving average, the green one, and is flirting, is about to break the 200 moving average. I would like to switch the moving averages though and switch them to 50 and 100. And I think that provides us a clearer picture. Also note the downward slope of the median of the Bollinger Bands, which is at the same time is also the 20 moving average. For the time being though, and as long as the price action of WTI respects the R1 83.20 and the S1 78, we tend to maintain a bias for the sideways motion to continue. Should the price action though drop, break the 78 support line, that would be in our opinion a change of trend signal and would be practically implying that the bearish scenario is possible. I wouldn't be surprised in such a scenario to see WTI's price starting to aim for the 73.60 support level which provides support here beautifully. While the even lower, the ultra low support line would be the 70.30, a level which provides support here. On the flip side, should the bulls take over, for a bullish outlook, we would require clear breaking of the 83.20 resistance line and the price action to start aiming for the 89 resistance level. For the time being, once again, and as long as the price action remains between the 83.20 resistance line and the 78 support line, we tend to maintain a bias for the sideways motion to continue. Let's have a look at US stock markets, and I would like to have a look at Dow Jones actually. Back to the 4-hour chart. That's better. Okay. Let's readjust a little bit the labels. I think here we have a very slight, but I think it's distinguishable upward movement of Dow Jones. And let me show you what I mean. Here it is. It's an interesting chart. Practically, the index is nearing a make or break position for the bulls. On the one hand, we have the upward trend line, which is guiding it, or seems to be guiding at least. On the flip side, though, note how the index has been dropping and is about to test it once again. And also note that the RSI indicator has been dropping and has reached the reading of 50. It was all the way up at 66.6, and has reached now the reading of 50. Should this downward motion of the RSI indicator continue and turn the market sentiment into a bearish one, we may see the price action dropping, breaking the upward trend line, Yet I would expect also a breaking of the 33,460 and the price action of Dow Jones to start aiming for 32,500. That would be a very plausible bearish scenario. On the other hand, should the stabilization take place, I would expect the price action to break the upward trend line. Once again, the first sign of a changing trend. But I would also expect it to respect the S1 33,460, a level which provided support here and has provided also support here. On the flip side, it has also provided to the upside such as the resistance line 1, 2, 3, 4 times resistance. So it's a pretty valid level. Any case, for a sideways motion, I would expect a breaking of the upward trend line, and the price action to respect both the S1 33,460 and the R1 34,400. That would be a very wide sideways motion. On the other hand, we have an upward trend line which is still valid. It hasn't been clearly broken. It's about to be tested, but still. And should the price action bounce on the upward trend line, I wouldn't be surprised to see it breaking the 34,400 resistance line, a level which provided resistance beautifully here, here, and here, and here. So that's a pretty valid level as well. And start aiming for the 35,500. I think in the next 7 days we're going to be having such US releases, both from the earnings reports as well as the financial data and monetary policy event. Don't forget we have the Fed's interest rate decision, which could have, or if you prefer, could intensify the movement of Dow Jones. I would like to have a look also at NASDAQ, just a quick glance. Okay, here the things here are pretty clear. I wouldn't be writing this as wide. Nice upward trend line. Note the consecutive higher peaks and higher truths. It would have to correct the levels a little bit. Definitely this will have to be corrected to the resistance support line, sorry. Let's go hunting for a resistance line. Here you go. Nice peak here. A little bit lower. Here you go. Touch and touch to the downside as well. That would be the red. 12,825. To readjust. For the time being, we tend to maintain a bullish outlook, albeit we have to note here that a correction seems to be in play. And should that correction be extended and the price action breaks the upward trend line guiding the index, that would cause us to switch our bullish outlook. $11,300, 11,735, R1 12,120, 12,450 as the R2, and the final one would be the 12,825. Yep. Now, for a bearish scenario, albeit it seems to be a little bit extreme, would require a breaking of the upward trend line, but also breaking of the 11,735. It's a little bit off the charts, but it's a possibility and should be covered. And that should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello, my name is Christina, and today I will talk about leverage and margin. Leverage is having the ability to control a large amount of money using very little of your own money and borrowing the rest. It is like a loan that is provided to the trader by the broker. Leverage is expressed as a ratio. Margin is the amount of money needed to open a position with your broker. Basically, it's a down payment on a trade and is usually expressed as a percentage of the total value of the position. Most forex brokers say they want a margin of 2%, 1%, 0.5%, or 0.25%. Essentially, with leverage, you're able to control a large position with a small initial investment. For example, you have a $10,000 trading account and you want to put up $1,000 as your down payment. The $1,000 is your margin. If your broker offers you 1 to 100 leverage, this means they're willing to let you put only 1% of the total value of your position. With a margin of $1,000 and leverage of 1 to 100, your broker will increase your down payment 100 times. Therefore, you will be able to control a position of $100,000 or a standard lot. Thank you for watching.
So welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free, like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders. Right, please don't take it. There's no signals, there's no forecasting here. Okay, if you guys are waiting for the entry, the take profit, the stop loss, you're not gonna find it in this webinar because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading forex and CFDs carries significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay, for those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company. Okay, what we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah, blah. And we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Average Fortune Group, we're the finalists for the best Forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my Forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I grow with you in this webinars, I can show you guys how I manage to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at 2 today, and we're gonna look at the natural moving average. So natural moving average is a kind of strategy, moving average that we use here as Average Fortune Group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. Right, so this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me. We will get to the natural moving average towards the end of the slides or midway of the slides. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to TradingView so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff, you know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average, blah, blah, blah. I can tell you so much about the moving average, but ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to TradingView if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. That's the most, I try but don't understand. Okay. Yes, we got a lot of yeses. Yes, this is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress, okay? You see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay. So similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition. Right, again, I will go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp. Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all a little basic backstory on the moving average, and then we will try to go into applying it. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks. Okay, if you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candles. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at Everest Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So, okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. Okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that. Okay, so a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today, we are going to look at 3 kinds of moving average. One is, oh, sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know. And that's totally fine. Again, more importantly, is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So trader use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as this was a calculation. Let me go back to the last slide. So yes, this is basically a calculation. Okay, it's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15. Okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average. Okay, an exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? It's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the 2 technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition? The definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, by the way, if you guys are wondering why I'm from Everest Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration, okay? We have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better, okay? So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video said to use. Okay, Kurt, I was using the 50 and 100 as well. It's called the Golden Cross and the moving average. Okay, right. I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid a few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at Everest Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references, okay? You have a very beautiful mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts and it does not work on all time frames and all pairs. So the 50 Smoothen 10 LWMA low price. Is this okay? Is that a setting that you use, Henry? right? So we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear out draw. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance, okay? The moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy, okay? So that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 50 minutes or the 1 hour? Okay, when it comes to moving average or any kinds of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me, if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim, I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because, remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to the setting and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were get to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average, and we would have missed this buy entry here. Whereas here on the A charts, okay, price nicely touched the moving average, and you enter here for the buy. Okay, so this chart is more accurate. We can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective. Okay, so we have found that this is the most effective way to use it. Okay, let's let me just remove all the drawings. Sorry. Okay, bonus: combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that that is commonly used, which is to get in for the buy. Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy. The support resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today. Okay, give me a sec. Let me exit. Let me share a new screen. Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any forex pairs? Sugar is a very uncommon. Okay, I think sugar is a future. It's usually a future chart, right? Okay, let's see how well. Maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a forex pair, because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart particular, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24-hour chart. This chart is closed. Okay, let's try to do GBP NZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP NZD. Okay, we chose GBP NZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP NZD? What forex pair is closely related to GBP NZD? There is correlations with pair. It's the same with USD, the Canadian dollar and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay, just go to my FX book. My FX book is a good one. Okay, this is where you find correlation. Okay, let's say you're looking for the GBP EUR, actually the GBP NZD. Okay, the GBP NZD, when we compare it to the EUR NZD, EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD, okay? So one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new, okay, and it will show below it, right? It will show below it. Just go into settings and change that into, just change that to, I want to change this to a candlesticks pattern chart. Okay, these settings are tricky, it doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'm gonna get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. Let me get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. We want to see what's happening on both charts. So this is the GBP AUD. and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally, you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective moving average is not an effective indicator on the 1 hour on a GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, the 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good settings that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here, it came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the first time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, comes and reverse here, it breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay, let's get rid of everything else. Trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings, right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay, we only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just gonna draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and NZD. So you're using the correlation on both the charts because, again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know, when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay. If you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm, the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance. Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at a channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. Two, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, three, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's three, why I think price is going to go up from here. Four, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings, okay, guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm gonna get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything, okay? The probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade, okay? So that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree. Trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. Yes, more importantly, hope you learned something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye, guys. Thank you so much. Are you or Desmond taking the trading tomorrow? It should be Desmond. It should be Desmond. Tomorrow is live trading analysis, right? Tomorrow is the live charts, right? It should be Desmond, right? Because I will have another webinar to take, right? But if you guys wanted me to take it, you guys can just write in to IronFX and tell them, just write in, maybe drop an email, say that you prefer me, or it doesn't matter, because me and Des, we can swap any day. It doesn't matter, it's just what you guys prefer, because ultimately, again, we are doing these webinars for you guys so that you guys can learn better. Okay, so thanks, guys. I will see you guys again soon. Okay, bye.
Everyone, my name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high, and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy, as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of the Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.